Ladies and gentlemen, welcome back to the channel. We got bad data today, and yet stocks rallied. You know what that means, right? That means, well, that's bullish. That's good. When stocks rally on bad news, yeah, I don't know. It's hard to be a bear right now. I will tell you that. So here in this video, we will share with you all of your big news, everything you need to know on markets for the day today. So building permits came in weaker than expected at 1.41 million today. The expectation was 1.45 million, and housing starts came in at 1.36 million. The estimate was 1.37 million. So nothing good to really report there. Building permits month over month even dropped about 5%. The expectation was only a 1% drop. So really no good news in any of the other data. Really no good news anywhere, okay? Michigan consumer sentiment came in at 50.8. The expectation was actually we would improve to 53.4. So, yeah, a really bad number today. 5-year inflation expectations came in at 4.6%. Last month was 4.4%, and the expectation was 4.5%. So 5-year inflation expectations up more than expectations. Consumer expectations came in at 46.5. The estimate was 48. So really bad there. Current conditions came in at 57.6. The expectation was 59.6. So again, missed there as well. Look at that. 1-year inflation expectations last month were 6.5%. The expectation was 6.6%. You came in at 7.3%. That is insane. Okay, now here is the underlying report. The University of Michigan consumer sentiment for the U.S. dropped sharply to 50.8 in May of 2025, down from 52.2 in April and well below market expectations of 53.4, according to preliminary estimates. This marks the 5th consecutive monthly decline, the lowest reading since June of 2022, and the second lowest on record, as mounting inflation expectations and renewed concerns over tariffs continue to weigh on sentiment. Both the current conditions index and expectations gauge worsened. Current assessments of personal finances sank nearly 10% on the basis of weakening incomes. Tariffs were spontaneously mentioned by nearly 3/4 of consumers, up from almost 60% in April. Uncertainty over trade policy continues to dominate consumers' thinking about the economy. On the trade front, inflation expectations for the year ahead surged to 7.3%, a new 1981 high from 6.5%. And long-run inflation expectations edged up to 4.6% from 4.4%. So this is the highest one-year inflation expectations you've had since 1981. What's fascinating about this survey is if you know Trump supporters, okay, I'm just going to say it like this. They don't expect inflation, right? They expect, that it's going to take some time for the economy to get better, but they're not expecting inflation. They're not expecting a recession. They actually think we're on the right path. So this University of Michigan survey, I don't know who the hell they're surveying. They must be like heavy Democrats, because if you talk to half of the population out there in America, they actually feel pretty good right now, all things considered, right? So there's definitely some weird things going on within this survey that don't make a whole lot of sense. But even despite that, your growth stocks today are outperforming. The S&P is up 0.1%, like not a terrible day, not a great day either. You're just continuing to kind of grind higher. The S&P breaking above that 490 level gives us probably a cleaner path to 600 on the SPY. I do expect a little bit of a slowdown of this rally at some point, but the fact that markets are going up on quote unquote bad news is definitely a good sign. And as you will see in this clip from JP Morgan's head of asset management, he actually says the consumer sentiment numbers this morning are not nearly as bad as you'd think. And he actually sounds kind of bullish on markets, which he's not like super bull. He's not like super bear, and that leads me to be bullish because I think there's a lot more of a bull case right now than even he does. Take a listen to this.
We're going to asset management global strategist David Kelly. David, good to have you here.
Glad to be here.
I don't know. I know you've been walking around, but we just got the sentiment data. Very, very weak. Does it matter?
Not actually for consumers. First of all, I would be a little careful about this number. They only poll about 250 to 300 people, which is way too low for a survey in the first half of the month. So the survey sample is size really small. In addition, they made a change to that survey last year, moving from telephone interviews to online interviews, which we think cost them 6 points. So it's not quite as bad as it looks. I mean, it is. But having said that, look, consumers are resilient. But there comes a point where you squeeze them enough in terms of tariffs, we're collecting on the student loans again, and then just the general worry and of course the cutbacks to the government sector. All of these things I think are beginning to weigh on consumers. So I think it is slowing the economy down. Still not willing to say recession.
Right.
The really key question here is not consumer behavior, it's business behavior. Because businesses seem to be so reluctant to lay people off. They had such a hard time hiring people the last few years that until they see the whites of the eyes of the recession, they don't want to lay people off. And actually, when you look at retailers, until they see the whites of the eyes of recession or of the tariffs, they don't really want to push up these prices. They'd rather say, well, look, on the current stock, this is what it cost us. This is our markup. Here we are. Now, the new stuff that comes in at the ports, that's going to be more expensive for us, so we're going to mark that up. But I think they're also playing wait and see. So everybody's waiting to see what these tariffs really do to the economy.
Well, looking at JP Morgan's analysis of retail sales, we just mentioned it, but if in fact they're eating some of the tariffs through their margins, your argument is that's not good for the economy either.
No, I mean, the whole and the uncertainty. I mean, there's this uncertainty tax which is being levied by Washington, which is bigger than all the other taxes combined. I mean, it's you have to, in business, small business, big business, you have to make decisions. And what happens is everybody freezes. And what I think people don't realize is we've got such a dynamic labor market. And if you look at the job openings, labor turnover report, we hire 65 million people per year in this country. 62 million people lose a job, but 65 million people get hired. That's 250,000 hires per day. If you just hold off a little bit, maybe let's just put a pause. We're not going to approve this hire. You just do that a little bit, it can really slow the economy down.
We're not seeing any signs of it yet, are we?
No, we're not. And at the moment, I'd have to say, the tariff pullback and also this big tax bill, which is going to put stimulus into 2026 and a little stimulus into 2025. That takes us from more than likely going to have a recession to less than likely going to have a recession this year. So I think the economy may be resilient enough to avoid recession, but it's going to be slow growth for a while.
Although one caveat you guys threw out there this week was that there's a chance those things don't go as well as some hope. The regulatory and the fiscal stuff. Oh
well, yes. I mean, first of all, it's going to be a difficult thing getting this whole bill through Congress. But the other part of it is, longer term, we're pushing up the deficit again. We're going to end up in 4 years' time with a deficit close to 7% of GDP. It's 6% of GDP right now. It's going in the wrong direction.
Because of slower growth.
Well, part because of slower growth, but guess what? We've also had another dose of fiscal fudge. We've got 4 years of tax cuts.
The tax bill
is paid for 10 years of future spending cuts, and we see this all the time.
And we hear warnings about this all the time. But is there really any evidence, David, that it's going to stand in the way of an equity market rally or even a bond market rally? Even when we had these higher yields, we were wondering, is the deficit front and center again? But guess what? Then we see buying reemerge.
The bond market maybe, because we're going to have to spend $2 trillion per year financing. We're going to have to find $2 trillion per year just to finance this deficit, going up to $3 trillion. And we also have this ongoing tariff issue. We're going to be close to full employment. We've got less available workers. All of these things say to me that inflation is not going to collapse. If the economy doesn't collapse and inflation doesn't collapse, the government's borrowing all this money. Pretty hard for the long end to rally that strongly.
Does that become an issue for equities ever?
I think it's all an issue for U.S. equities, U.S. fixed income. I mean, 60-40 portfolio has done so well for so long. People have got to calm their expectations here, diversify. International still makes a lot of sense. Value stocks still make a lot of sense. There are plenty of things to do, but don't just bet on large cap growth stocks with a little bit of bonds added in and expect to get double-digit returns per year, because I just don't think that's where we're headed.
And you don't think the tolerance for pain out of retail traders might make that a difficult thesis? I mean, they never gave up the ghost in April.
No, because we've been taught so many times to buy the dip. But at some stage, earnings matter, and even those confidence numbers. I mean, they may as I say, consumers are resilient, but investors might get a little nervous.
Yeah.
See, Wall Street moves very slow, and then they move all at once, right? The bears are not going to be super quick to throw in the bear towel and turn bullish. But when they do, they're all going to start at the same time. Okay, I don't know what the data point is, if it's a switch from Powell, what it is, but there is a lot of positive things happening from a deregulation perspective, from lower taxes, from, again, the China market opening up, the second largest economy, second largest population in the world, 1.3 billion people. I mean, these are material positives that Wall Street is going to have to embrace. And there is way too many bulls for where we are in this economy, right? Or way too many bears. We're not going into a recession right away. Who knows if we are going into a recession at all? With that, I think you have to get allocated to stocks, and that's why I think a 20% rally into year end is coming. Now that 20% rally puts the S&P at about 700. So you heard it first. I think the S&P is going to 700 by the end of this year, which from here is about an 18.3% rally. Again, just my expectations, could be wrong there, but I do expect that people are going to get FOMO to get back into this market here over the next couple of months. Now, with that said, today, NVIDIA says they are not sending GPU designs to China after reports of new Shanghai operation. Trump says that Republicans must unite behind this big, beautiful bill. He says that Republicans must unite behind the one big, beautiful bill. Not only does it cut taxes for all Americans, but it will kick millions of illegal aliens off of Medicaid to protect it for those who are the ones in real need. He says the country will suffer greatly without this legislation. With their taxes going up 65%, it will be blamed on the Democrats, but that doesn't help our voters. We don't need grandstanders in the Republican Party. Stop talking and get it done. Goldman Sachs today has raised their 2025 China GDP growth forecast to 4.6% from previously being at 4%. Mexican President Sheinbaum says Mexico's Foreign Minister Ebrard to continue talking about steel and aluminum tariffs. And Ukrainian Foreign Minister spokesperson says that Zelensky is ready for direct negotiations with Putin. And also being reported today, the U.S. will start discussions later this year on troop reductions in Europe, U.S. NATO ambassador says. So, ladies and gentlemen, have a great rest of your day, and I will see you in the next one.